Hey, what's up everybody? In this video, I'm going to look at the stock of General Mills and try and figure out whether it's a good time to buy or not. I'm going to analyze their balance sheet, look at their leverage ratios, check out their profitability with a DuPont analysis, and finally do a discounted cash flow analysis and just try and figure out whether there's value there. If you're new here, my name is Dan. I'm a business school professor focused on accounting and finance. This channel is all about investing, so hit that subscribe button if you like that. Alright, let's get into it. Alright, so never invest in anything you don't understand. And the way General Mills makes money is pretty easy to understand. They have a very diversified portfolio of brands, selling anything from fruit, ice cream, baking supplies, to vegetables, organics. You got pasta. They even sell some pet products, pizza, snacks, you name it. General Mills sells it in grocery stores around you. Here's a breakdown of their revenue from each of these categories. You can see, snacks, cereals, convenient meals, these collectively are the larger portion of their revenues, but they really get a significant amount from just about every segment, with yogurt coming in at 12%, dough at 10%, pet supplies another 10%, and baking mixes at 9%. So General Mills is really not dependent on any given food category, and they're pretty resilient to changing trends in eating. Also, geographically, they're fairly concentrated in North America, with 61% of revenues coming from there. But you get a little bit of diversification against currency risk here. You got Europe and Australia sales accounting for 10%. You got convenience store stuff, pet, and then Asia and Latin America at 9%. So here are some stats from General Mills' balance sheet. You can see they have a pretty fair leverage ratio, with the liabilities to assets coming in close to 71%. Pretty standard for a mature company like this. The current ratio, the quick ratio, they're both a little low, but that's pretty common for a company that sells a lot during the year, like retailers or someone like General Mills. I don't like to see the quick ratio that low, but hey, it's not horrible. The interest coverage ratio is a little bit dangerous. 7.62. That means their income before taxes can only cover their interest expense 7.62 times. Little dangerous there. As far as the breakdown of their assets, most of them are long-term, with about 80% of them being long-term assets. And quite a number of assets are intangible. About 65.5% of all their assets are intangibles, like brand power. So we have to keep this in mind, guys. When you look at the liabilities to assets ratio, that's total liabilities divided by total assets, which includes those intangibles. If you only look at actual tangible assets on hand, the liabilities to assets ratio would easily be over 100%. Okay, so I'm not loving the balance sheet, but it's not the worst. Here is a DuPont analysis to analyze their profitability. So this just breaks return on equity into its three parts: net income margin, asset turnover, and equity multiplier. Check out my video in the description if you don't know about this. But, General Mills' return on equity is pretty impressive. It has bounced around a little bit, but, pretty steady, anywhere from 25 to, hitting 38% in 1 year. That was a really good year. So I'm loving that. How do they get there? Well, they actually have pretty good margins for a food producer. You can see they make, about 13.2 cents out of every dollar they sell. They keep 13.2 cents as profit. Not bad. And asset turnover is, anywhere from 0.55 to 0.72, average of 0.64 or something. That's not bad. For every dollar of assets, they generate, 59 cents of sales in the past year. So to me, they have strong fundamental profit generating capabilities. The equity multiplier is part of their profitability, guys, leverage there. But it's not, abnormally high. It's not terrible. So I really like to look at this DuPont for General Mills. Pretty good. All right, here's a graph of their growth in revenues over time. They were actually doing better in the early part of last decade. They really hit a low point there in 2017. But since then, it's been pretty incredible growth. I really like what we're seeing here. And keep in mind that last bar is a trailing 12-month measure. So that's really not accounting for the full growth that we're probably going to see when they file their May 2021 financial report. They have been able to maintain pretty darn consistent operating margins and gross margins over this period, and I love to see that. These are pretty good margins, guys, especially for a company that produces hard assets like food. One of the reasons a lot of people are interested in companies like General Mills is their steady increasing dividend. So you can see in blue here, they paid dividend of $1.92 a share, going up to $1.96 for 3 years straight, and then $1.98. So really not a lot of dividend growth. But realize, guys, whenever the company spends money to buy their own shares back, that is a lot like a dividend. That is giving back to shareholders. And that's what we have in red here. We have even more money given out to shareholders in buybacks than they did in dividends in 2019, and quite a bit in 2020 as well. Now, the company is in excellent shape as far as their ability to keep paying those dividends. You can see their payout ratio in blue, and they have not paid more than 56% in 2019 of their total profits out as dividends. So that leaves a whole lot of extra room to do other things with the money, like reinvest or buy their own shares back. Now in green, I have the modified payout ratio, which is equal to all the dividends they paid plus all the money they spent on buybacks divided by their total profit. And so basically that is quite a bit higher, but it is not, it's not overly high, the trailing 12-month period. They can still increase their buybacks. Alright guys, so now it's time to value the company. Let's have a quick look before we get into a deeper analysis. You can see they have a price to earnings ratio with the forward earnings there of about 15. That's pretty impressive when you consider the revenue growth they've been experiencing over the past few years. I would expect a growing company to command a little bit of a higher PE ratio. They also have a nice dividend yield at about 3.6%. They're about a $35 billion company. Now, as far as their expected growth in earnings per share, analysts, there's a lot of analysts following the company. They expect, here it is, 3.8, a little negative, then 3.7, going up to 7.37% growth. And then after that, this is just the opinion of one analyst for the years after that, so I really don't put a lot of weight on that. But you can see, they're not expected to be able to grow their earnings per share by very much over the next few years. Alright guys, if you like the content so far, please hit that like button, hit that subscribe button. It helps me a lot. But at this point in the video, it's time to use our discounted cash flow analysis. To do that, I'm going to use the free cash flow to equity model. To make the model work, I need a discount rate. Now for General Mills, they're fairly safe. The leverage ratio is not horrible. It's not great either. I think a modest discount rate of anywhere from 6 to 7% is fair. Some people might choose a little higher. I'll show you guys the results using a variety of discount rates. I also need to estimate how much free cash flows to equity can grow over the next 5 years. Based on the analyst forecast data and based on how they've been growing, I think we have a pretty consistent picture here. I think about 5% is fair, but I will show you how the results change if we adjust those growth rates a little bit. I then need to estimate how much General Mills can grow their earnings by every year after that 5-year period. So I'll be conservative here. I'm going to pick a pretty low perpetual growth rate, just assuming they can keep up with inflation, probably about 1.5%, maybe 2% every year. Once I have all these numbers, I plug them into the model, and let's have a look at the results. Alright guys, so here I have a valuation matrix. What we're doing here is showing you the fair value of General Mills assuming a given discount rate and a given growth rate in the free cash flow to equity over the next 5 years. After that, we're assuming a 2% growth rate in perpetuity. So for example, this cell right here indicates that if they're able to grow their cash flows at 6% a year and they can have a 7% discount rate, the stock would be worth $56.93. Another way of interpreting this whole chart is to say the following. If I desire a 9% return and I think the company is able to grow their free cash flows at 8%, then I shouldn't be paying any more than $43.30 for a share of General Mills. What we can see here is a variety of outcomes, and it really depends on your assumptions. For me, I think 7% is fair. So I would be in this row. As far as the growth in free cash flows, analysts are a bit more pessimistic than recent history would indicate. They've actually grown their net income quite substantially over the past couple of years. So for me, I said anywhere from 5 to 8% growth is possible. But to be conservative, one of these cells here is more conservative. And given the share price today, that would be a fair deal, not a great deal. To get more insight on that, check out the chart below where I color code it red or green depending on whether it's over or undervalued. So the most optimistic scenario you got is 40% undervalued, but that is quite optimistic. So in any case, to me it doesn't look like a great deal. It's a fair price. Here is insider trading activity for General Mills. Sometimes we can gain a little insight. If the insiders are buying up shares, that's normally a very positive signal. We don't have that in this period. In the most recent 3 months, we got more sells than buys. As far as the number of shares involved, you got about 5 times as many shares sold as shares bought. So really no evidence that anything good is coming there for General Mills. Not the worst signal either. I don't see, a million shares being dumped here, but, not positive either. Okay guys, so here are my final thoughts on General Mills. I think it's a fair value, to be honest. The company has some leverage. They have some liquidity concerns there. Not overwhelming, but it's not a super safe investment. Their profitability is pretty consistent and pretty impressive. They pay a nice dividend, although they don't raise it as much as I would like. They have good buybacks. It's really not a bad company. If it was me, I would try to wait for a better entry point. I think at the price right now, based on the cash flow analysis we've done, it doesn't seem like a great deal. You got to compare everything to your alternatives. Right now, I can get, close to 6.5% on preferred stock, which is pretty low risk, right? I can buy a preferred stock fund or something. I can just invest my money in the stock market in general. I can put it in the Russell 2000. I get a pretty good return there. So for me personally, to invest in an individual stock, I would like to see the potential there for a higher return. And I don't really see that here. I think it's a fine company to own in your portfolio. If you want to diversify, you want to have a stable food industry company, I think General Mills can fit your bill there. But I wouldn't expect amazing things from it at this price. So those are just my thoughts. Let me know what you guys think in the comments. Thank you for watching.